Hi, I'm Roger Montgomery and welcome to this week's Video Insight. We've just commenced reporting season for 2023 and it seems like earnings are on shakier ground this time around, and there are some interesting themes to watch. With reporting season underway, there are some concerns about the economy's strength, especially after months of elevated inflation and higher interest rates. Soft trading updates from retailers in May and June have further reinforced this view. During August and September, you should expect macroeconomic factors to take a backseat while attention shifts to company fundamentals. FY24 earnings per share growth for the ASX 200 industrials has halved from 12% back in February to around 6% today. While this may seem like a headwind, it's important to remember that this growth rate is just marginally below the 20-year average earnings per share growth rate for ASX industrials, which stands at about 7%. And with demand slowing down and interest rates rising, the spotlight is back on balance sheets and gearing. Companies may consider fixing or hedging borrowing to manage debt obligations, especially with business lending costs increasing significantly. Looking beyond Australia, we might be able to gain some insights from the US reporting season so far. Positive margin surprises have been driving results there. However, sales misses have been met with punishment, possibly signalling reduced pricing power. And as analysts downgrade forward estimates, we need to pay attention to our own market dynamics. According to Macquarie's equity market view, consensus estimates for earnings may be too high, and margins may not rise as expected next year. They also have a preference for defensive sectors like utilities, infrastructure, and insurers in the coming weeks. But prices for defensives already reflect their preferred status. Meanwhile, a critical point to remember though is that earnings are all about margins, and Macquarie points out a red flag. The split between falling margins and flat earnings per share growth hasn't been seen since 2008, suggesting there's still some optimism baked in, and that may need to wash out. Macquarie reckons, and I quote, "The net profit margins for the oil industrials has been falling in 2023, but the impact on EPS has been muted by rising sales as companies continue to pass on inflationary cost increases." This dynamic was last seen around the GFC when margins peaked and started to fall before the US recession began. They also added, "We could see a similar sequence play out again over FY24 as inflation slows, especially if central banks continue to hike." On a PE basis, Macquarie analysts note that although sentiment and volatility may be depressed, valuations aren't. Macquarie adds, "We also believe valuations will decline as earnings fall, as was more typical in the pre-QE environment before the global financial crisis." I would add that the all industrials PE is high, or its inverse, the earnings yield is low relative to current real bond yields, and that's potentially a risk. But I also note that we've got a combination of deflation and economic growth, which is supportive. As always, companies with a growing earnings profile, strong cash flow, and trading at reasonable valuations are the best places to invest, as they'll be less prone to earnings and share price erosion. The top 5 holdings in the Montgomery fund at the 30th of July were the Commonwealth Bank, CSL, QBE Insurance, Rio Tinto, and Cochlear. And remember, Rio Tinto has already reported its half-yearly results. The top 5 holdings in the Montgomery Small Companies Fund at the 30th of July are Bapcor, Macquarie Technology Group, Alliance Aviation, 7 Group Holdings, and Hub24. We will obviously be watching the performance of those companies very closely indeed. That's all we've got time for. Thanks for joining us this week. Look forward to talking to you again next week, and in the meantime, continue to follow us on Facebook and Twitter.